Stop for a moment and clear the noise out of your head, because what we are looking at right now is not another routine market fluctuation, and it is not a short-term trade setup. Today, we are standing at the edge of something structural, something that has been building quietly for years beneath the surface of the silver market, and most people still think this is just volatility. It isn't. There is a single pressure point forming in the system, and when pressure builds long enough in a closed environment, it doesn't release gently, it ruptures. What makes this moment different is not just price movement, it's convergence. Independent stress signals from India, Shanghai, Mexico, the United States, and the futures market are all pointing in the same direction at the same time. When that happens in finance, you pay attention. Today marks first notice day for the March silver contract, and that matters more than most understand. First notice day is when long holders must decide whether they want cash settlement, a rollover into a later contract, or actual delivery of physical metal. In normal cycles, only 3 to 5% ever ask for delivery. The system was built on that assumption. The futures market functions smoothly because most participants want exposure, not metal, but recently something changed. Delivery demand surged toward 98%. That is not a statistical anomaly. That is a behavioral shift. And when behavior changes inside a leverage-based structure, leverage becomes risk. Before we go further, consider this. There are roughly 400 million ounces tied to the March contract. Against that, only about 82 million ounces sit in registered inventories ready for delivery. That puts the paper-to-physical ratio near 360 to 1. For every ounce that can theoretically be delivered, there are hundreds of claims. That ratio only works if confidence holds. It only works if most people never ask for what they technically own. The moment more participants decide they want metal instead of dollars, the math stops cooperating. But this story doesn't begin in New York. It begins in India. India's securities regulator made a decision that will echo through global bullion markets for years. They officially abandoned the London Bullion Market Association benchmark for pricing gold and silver and shifted toward a domestic pricing average. For decades, the LBMA fix set in London has been the reference price for central banks, refiners, manufacturers, and investors worldwide. It was considered the heartbeat of global bullion pricing. India stepped away from that system. That is not administrative housekeeping. That is a geopolitical message. India is one of the largest consumers of precious metals on Earth. Indian households hold more gold than many central banks. Gold and silver are not speculative assets there. They are cultural, generational stores of value. When weddings happen, when families preserve wealth, when uncertainty rises, bullion becomes the default. At the same time this pricing shift occurred, approximately $384 billion in Indian equity capital began rotating toward gold and silver. That is capital leaving financial assets and entering tangible metal. That is not speculation. That is repositioning. Now move east to Shanghai. The Shanghai Futures Exchange Silver Vault experienced an overnight withdrawal of nearly 40 metric tons, specifically 39,773 kilograms. That single session drain pushed inventories below 10 million ounces. Shanghai is not structured like the COMEX. Contracts there settle in physical metal. When delivery is demanded, metal moves. It is not a cash settlement casino. When vaults drain in Shanghai, it reflects genuine physical tightness. Silver has been pressing toward $94, a major long-term technical resistance level. If that level breaks cleanly, the structure of the market changes because short positions lose control of the tape. Suppression mechanisms that function in paper markets struggle when physical supply tightens simultaneously. And here is where it becomes critical. When both Shanghai and COMEX experience tightness at the same time, arbitrage mechanisms that normally stabilize pricing begin to fail. Premiums expand. Divergence grows. We have already seen Shanghai physical premiums trade 40, 50, even 90% above COMEX paper pricing. That is not a healthy arbitrage gap. That is two pricing realities coexisting in conflict. Paper markets suggest one valuation. Physical markets suggest another. And historically, when divergence persists, physical wins. Supply pressures compound the problem. Mexico, one of the world's largest silver producers, is facing disruptions tied to cartel violence affecting mining regions and transport routes. These developments do not dominate Western headlines, but they directly affect metal flow. Corporations are not waiting to see how this resolves. Samsung secured a 2-year exclusive offtake agreement from a Mexican mine, bypassing exchanges entirely. That action signals concern about reliable supply through futures channels. When a global technology manufacturer chooses direct sourcing over exchange access, it reveals institutional caution. More industrial buyers are moving toward long-term contracts and strategic stockpiling. They are not trusting futures markets to deliver metal on demand. They are securing it upstream. That is crisis behavior, not routine procurement. Meanwhile, in the West, financial stress intensifies. COMEX has experienced multiple technical interruptions during sharp price movements. Trading halts, system freezes, and so-called connectivity disruptions have occurred precisely during volatile sessions. Official explanations cite technical issues. But markets that fail under stress are not stable systems. They are fragile ones. Macroeconomic data reinforces the tension. Searches for can't sell house in the United States reached record levels, exceeding even the prior housing crisis peak. Credit card delinquencies for accounts more than 90 days overdue stand at 12.7%, the second highest reading on record. Consumer balance sheets are strained. National debt has climbed to $38 trillion, and interest expense now surpasses the defense budget. The government is borrowing to service previous borrowing. That is compounding pressure, not stability. All of this forms the backdrop against which silver trades. A tangible asset with industrial necessity and monetary history is priced inside a debt-saturated system built on leverage and confidence. Inventories at COMEX have fallen below 100 million ounces for the first time in the modern era of futures trading. Withdrawals average roughly 785,000 ounces per day. Metal is leaving vaults steadily. Here's the question that creates the real tension. What happens if even a fraction of that 360-to-1 leverage ratio is tested? What happens if delivery demand remains elevated instead of reverting to normal? If confidence is the only glue holding a leverage structure together, what occurs when participants begin doubting that glue? Today is not just a calendar event, it is a stress test, and stress tests do not reveal problems when systems are comfortable. They reveal them when participants act differently than expected. Now ask yourself this, and be honest. If institutional buyers are locking direct supply, if India is rejecting Western price benchmarks, if Shanghai vaults are draining, and if delivery intentions surge far beyond historical norms, what does that tell you about the direction informed capital is leaning? Are they positioning for routine volatility, or are they preparing for repricing? Step back now and widen the lens, because what we are witnessing is not confined to one delivery cycle or one vault report. The deeper issue is structural, and structures fail when imbalance becomes chronic. The global silver market is currently operating in a persistent monthly deficit estimated between 40 and 50 million ounces. That means every single month demand exceeds new supply by tens of millions of ounces. This is not a one-off shortfall. This has been happening consistently for years. Since 2021, the cumulative deficit is approaching 820 million ounces. That number is staggering. It represents metal that theoretically should exist in inventories somewhere, but does not. It represents promises made against production that never fully materialized. Deficits can be absorbed temporarily by drawing down above-ground stocks, but when those stocks thin out, price becomes the only balancing mechanism. Where is the demand coming from? It is not primarily speculative coin buying, it is industrial necessity. Silver is a critical component in solar panels, and solar capacity expansion globally continues at exponential rates. Every panel requires silver for conductivity. That demand does not disappear because price rises. Silver is embedded in electronics, and modern electronics are everywhere. Automobiles, refrigerators, smartphones, data centers, and industrial machinery all rely on silver's conductivity and durability. The digital infrastructure of modern life consumes silver quietly and continuously. It extends further. Silver is used in medical devices, antimicrobial coatings, water purification systems, electric vehicle batteries, and charging infrastructure. Military and defense applications incorporate silver for reliability in high-performance systems. Even the artificial intelligence hardware that powers advanced computing relies on components that require silver. This is not decorative demand. This is functional demand. Industrial demand cannot be postponed indefinitely without affecting production lines and technological growth. At the same time, demand expands, supply growth is constrained. Primary silver mines are relatively rare because most silver is produced as a byproduct of mining other metals such as copper, lead, and zinc. That means silver supply depends partly on the economics of entirely different markets. If base metal mining slows, silver output slows as well. And when geopolitical instability disrupts production regions, even incremental shortages compound quickly. China plays a dominant role in refined silver output, and recently tightened export controls indicate a preference to retain more metal domestically. Prioritizing internal industrial needs limits the flow of silver to Western markets. When a major refining power holds back supply while Western inventories shrink, tension builds. This is not a transient imbalance caused by speculation. It is structural realignment of supply flows. Overlay that with what is happening at COMEX. Inventories have fallen below 100 million ounces for the first time in the modern futures era. That is a historical marker. Registered inventories, the category available for delivery, sit near 82 million ounces. Meanwhile, roughly 400 million ounces are tied to open interest in the March contract. A 360 to 1 paper to physical ratio is not just high, it is extreme. It functions only if behavior remains predictable, but behavior already shifted once. Delivery demand surged toward 98% during the prior cycle. Even if that figure moderates, even if it drops substantially, the psychological precedent has been set. Market participants demonstrated a willingness to demand metal rather than settle in cash. Once that door opens, it does not fully close. During the January crash, silver fell sharply from $121 to $64 in a single session. Under normal conditions, such a price collapse would coincide with metal flowing back into vaults as investors capitulate. Instead, vaults lost approximately 3.3 million ounces in a single day. Price fell, yet metal left. That divergence is revealing. It suggests paper liquidation rather than physical distribution. Algorithms, margin calls, and leverage positions unwound, but long-term holders accumulated metal into custody. Price down, metal out. That inversion should not be ignored. Now consider the broader Western macro backdrop. U.S. housing market stress is rising, with search data for selling difficulty exceeding prior crisis peaks. Credit card delinquencies at 12.7% signal strain among consumers. National debt at $38 trillion places interest expense above defense spending. Borrowing funds to service prior borrowing accelerates compounding obligations. When sovereign balance sheets deteriorate, confidence in fiat-denominated assets weakens incrementally. Silver occupies a unique space in this environment. It is both industrial input and monetary metal. It carries 5,000 years of history as a store of value while simultaneously powering modern technology. It cannot be printed, digitally expanded, or algorithmically created. Its supply growth is limited by geology and mining economics. In a debt-heavy system facing compounding interest burdens, tangible assets historically gain relative attractiveness. Now imagine two scenarios. In the first scenario, delivery demand remains elevated into this contract cycle. Even if it does not reach 98% again, even a modest increase beyond historical norms could pressure registered inventories. COMEX would face a choice: deliver from limited stock, source emergency supply, or encourage widespread cash settlement. Cash settlement preserves the appearance of functioning markets, but it exposes the leverage imbalance. If holders who expected metal receive dollars instead, confidence weakens. When confidence weakens inside a 360 to 1 structure, repricing does not happen gradually. It accelerates. Silver could breach $94 decisively. If that resistance level gives way, three-digit pricing becomes not hypothetical, but mechanical. Shorts positioned for containment face covering pressure. Mining equities, which held firm during corrections, would reflect anticipated cash flow expansion. The gold-silver ratio, currently elevated relative to prior bull market lows, would likely compress as silver outperforms in percentage terms. In a more extreme extension of this scenario, pricing authority shifts further east. India's rejection of LBMA benchmarks becomes precedent. Other nations consider localized price discovery anchored in physical settlement rather than paper derivatives. The global market fragments into physical hubs and financial hubs, and physical begins dictating terms. In the second scenario, the system stabilizes temporarily. COMEX invokes contractual flexibility, sources additional metal, converts eligible stocks to registered, or incentivizes rollovers. Delivery demand cools. Headlines declare fears exaggerated. Paper pricing consolidates. Shorts regain composure. The deficit persists, but the reckoning is deferred. Both scenarios are plausible. The difference lies in behavioral momentum. Once participants question whether paper claims equate to guaranteed delivery, psychology changes. Here is where the curiosity deepens. What are institutional actors doing quietly? Industrial buyers already secured direct supply agreements. That signals preparation. Asian pricing benchmarks are decoupling. That signals independence. Physical premiums in Shanghai previously reached 40, 50, even 90% above paper prices. That signals divergence. When sophisticated players act preemptively, it is rarely random. It reflects internal assessment of risk. Now ask yourself something critical. If silver truly were abundant and readily deliverable, would corporations bypass exchanges to lock exclusive mine output? Would a major consuming nation shift away from established benchmarks? Would delivery intentions surge toward 98%? These are not isolated anomalies. They are patterns. Markets can ignore arithmetic for extended periods when confidence overrides scarcity, but deficits accumulate silently. 820 million ounces of cumulative shortfall does not disappear through optimism. It must be resolved through increased production, reduced demand, or higher price. Production is constrained. Demand remains strong. That leaves price. The coming stress point is not merely a trading event, it is a credibility event. If paper contracts settle smoothly, leverage persists. If settlement strains, perception changes. And perception, once altered, rarely reverts quickly. Now bring everything together, because the true significance of what is unfolding cannot be understood by looking at isolated headlines. This is not simply about a contract month. It is not just about vault withdrawals or technical glitches. It is about fragmentation. The global silver system that functioned for decades as a unified pricing mechanism is beginning to split along geographic and philosophical lines. India's rejection of Western benchmark pricing is not an accounting adjustment. It is a declaration that price discovery anchored in London no longer reflects domestic reality. Shanghai's persistent physical withdrawals, while paper contracts trade elsewhere, represent two markets operating under different assumptions. Mexico's instability and corporate offtake agreements show that industrial users are increasingly bypassing exchanges entirely. The system is dividing into physical markets with metal and derivative markets with leverage. Those two realities cannot diverge indefinitely. The leverage imbalance at COMEX has reached levels that strain credibility. A 360-to-1 ratio between paper claims and registered metal is sustainable only when delivery demand remains minimal. The structure was designed around a 3 to 5% delivery expectation. That assumption allowed paper liquidity to expand far beyond physical stock. But the February surge toward 98% delivery intent signaled something different. It revealed that participants are willing to test the mechanism itself. Even if the percentage moderates, the precedent exists. The knowledge that the structure can be challenged alters behavior permanently. Inventories falling below 100 million ounces for the first time in the modern era are not symbolic milestones. They are practical constraints. Withdrawals averaging roughly 785,000 ounces per day reduce buffer capacity steadily. Meanwhile, roughly 400 million ounces remain tied to contract obligations. Arithmetic does not bend to narrative. If even a modest fraction of longs choose delivery rather than cash settlement, pressure intensifies quickly. The macroeconomic environment amplifies this pressure. $38 trillion in national debt, with interest expense surpassing defense spending, signals structural imbalance in sovereign finances. Credit card delinquencies at 12.7% show strain in household balance sheets. Housing market stress, reflected in search behavior, suggests tightening liquidity. When confidence in debt-backed systems erodes, tangible assets historically gain appeal. Silver occupies a dual role, monetary hedge and industrial necessity. That combination gives it asymmetric characteristics in environments of fiscal strain. Now consider the behavioral component. During the January crash from $121 to $64, vaults lost approximately 3.3 million ounces. Price fell sharply, yet metal exited storage. That divergence implies that leveraged paper positions unwound while long-term holders accumulated. Smart capital often behaves counterintuitively during volatility. Instead of capitulating, it strengthens positions when price disconnects from fundamentals. That pattern deserves attention. Industrial demand continues absorbing supply relentlessly. Solar panel manufacturing scales globally. Electronics proliferation embeds silver in everyday infrastructure. Electric vehicle production requires conductive components. Artificial intelligence hardware relies on precision electronics. Military systems incorporate silver for reliability. These applications are not optional luxuries. They are integrated necessities of a modern economy. Substitution options are limited because silver's conductivity and durability are difficult to replicate at scale. Supply, by contrast, is constrained. Primary silver mines represent a minority of production, with most output derived as a byproduct. That limits responsiveness to price signals. Geopolitical disruptions in producing nations compound uncertainty. China's tightening of export controls indicates preference for internal allocation. When a dominant refiner retains more metal domestically, Western markets rely increasingly on dwindling inventories. The curiosity gap now narrows to a single question: what happens if confidence shifts decisively? If participants begin viewing paper contracts as conditional rather than guaranteed pathways to delivery, repricing accelerates. Confidence is invisible until it changes. When it changes, it moves rapidly. Two broad outcomes remain possible. In one, delivery demand stays elevated. COMEX faces tangible constraints. Cash settlement expands. The market acknowledges the difference between leverage exposure and physical ownership. Silver breaches $94 decisively and enters three-digit territory. Short covering intensifies. Mining equities re-rate based on expanded cash flow assumptions. The gold-silver ratio compresses as silver outperforms. Asian price discovery gains legitimacy while Western benchmarks lose dominance. Physical settlement becomes the anchor. In the alternative outcome, the system absorbs pressure. Eligible inventories convert to registered. Additional metal appears through imports or exchange-traded fund reallocations. Delivery intentions cool. The market stabilizes temporarily. Paper leverage survives another cycle, the deficit persists but the timeline extends. The difference between these outcomes hinges on behavior and confidence, not solely on inventory figures. When participants believe settlement mechanisms function reliably, leverage persists. When belief weakens, leverage becomes liability. Here is where fear of missing out enters rationally rather than emotionally. If physical repricing occurs, it will not unfold politely. Markets do not issue invitations before adjusting to scarcity. They gap. They accelerate. By the time mainstream confirmation arrives, price may already reflect new equilibrium. Historically, commodity phase transitions occur rapidly once structural thresholds break. At the same time, prudence remains essential. Leverage amplifies both gains and losses. Being correct on direction does not guarantee survival if position sizing ignores volatility. Structural analysis informs probability, not certainty. Markets can remain imbalanced longer than participants expect. Timing risk persists. Now consider social proof within this environment. Industrial giants securing multi-year supply agreements, a major consuming nation shifting pricing benchmarks, physical premiums in Shanghai previously trading 40, 50, even 90% above paper levels, delivery intent surging toward 98%. These actions represent informed actors responding to perceived imbalance. They are not retail impulses, they are strategic adjustments. Ask yourself honestly, if large institutions, industrial users, and sovereign regulators are repositioning simultaneously, what narrative are they seeing that casual observers are not? Are they anticipating marginal volatility, or are they preparing for structural repricing? Emotional highs in markets often follow long periods of complacency. For years, silver traded within expectations of abundance. Deficits accumulated quietly, leverage expanded, confidence stabilized the system, but pressure accumulates invisibly until it becomes visible. The convergence today is unprecedented in recent decades. Structural deficit nearing 820 million ounces, monthly shortfalls of 40 to 50 million ounces, inventories below 100 million ounces, paper claims of roughly 400 million ounces against 82 million deliverable, national debt at $38 trillion, consumer delinquency stress, export tightening from a dominant refiner, direct sourcing agreements bypassing exchanges. Each factor individually may be manageable. Combined, they form tension. Here is the engagement question that matters most. If you had to choose between holding exposure to a leverage promise or custody of tangible metal in a system where leverage exceeds 360 to 1, which would you trust during stress? Not as speculation, but as protection. The coming period will likely include volatility. Headlines may downplay concerns or exaggerate them. Price swings may test conviction, but the arithmetic remains constant. Deficits must resolve. Confidence must hold or adjust. Leverage must either be maintained or reduced. History shows that when monetary metals disconnect from paper derivatives, repricing tends to favor physical holders. It does not always happen immediately. But when structural imbalance aligns with behavioral shift, acceleration can surprise even seasoned participants. Today is not about panic. It is about preparation. It is about recognizing that structural convergence is rare. When it appears, ignoring it carries risk. Either the paper framework absorbs pressure once more and extends its lifespan, or physical scarcity asserts itself through price. Both paths lead to eventual resolution of deficit. The only uncertainty is timing and magnitude. So consider your positioning carefully. Consider whether you view silver primarily as short-term volatility or as long-term structural asset. Consider whether you believe confidence in leverage settlement will remain unchallenged indefinitely, because once confidence transitions, repricing does not wait for consensus. And when markets move from assumption to realization, they rarely ask permission first.